The month you stop working, 3 bills arrive that your paycheck used to absorb invisibly. Your employer's contribution to your health insurance, $14,600 per year on average. According to Kaiser Family Foundation, data from 2024 evaporates overnight. Your federal withholding disappears, which sounds like freedom until you realize estimated quarterly taxes are now your responsibility. And if you're under 65, Medicare won't touch you for 3 more years. That's before we get into what happens to your portfolio when you flip from loading mode to unloading mode during a bad market year. Specifically, why the sequence of your returns matters more than the total size of them, or what the IRS does to your retirement income at 73 when required minimum distributions collide with your Social Security and quietly push your effective tax rate above what it was during your peak earning years. Or why 77% more monthly income is legally available to people who wait until 70 to claim Social Security versus 62, and how most people permanently forfeit it for reasons that feel financially rational and empirically aren't. These are not separate problems. They are a chain reaction. And every single one of them gets triggered by the same event, the calendar date you stop working. So here is what I'm going to do today. I'm going to walk you through exactly what happens to your money during that transition, mechanically, mathematically, and psychologically. Not the retirement checklist content. Not the 401k maximization framework you've seen 17 times. The actual failure modes, the ones that don't appear in standard retirement projections because the people building those projections have financial incentives to keep the analysis simple. Let me give you a mental model first, because it's going to follow us through this entire video. Picture a cargo tanker, not a sailboat. 150,000 ton ocean tanker, the kind that moves crude oil across the Pacific. For 30 years, you've been loading cargo. Every paycheck contribution, every reinvested dividend, every year of compounding returns cargo going into the hold. A fully loaded tanker sits low in the water. It's heavy. It's stable. 15-foot swells are irrelevant to a ship that weighs as much as a small skyscraper. The day you retire, you flip the direction. You stop loading, you start unloading. And here is the thing nobody explains. Tankers are engineered for the loading phase. The cranes, the pumps, the entire crew training manual built around cargo going in. When you reverse direction and start pulling cargo out, the physics change completely. The ship rides higher. The center of gravity shifts upward. Waves that barely registered when the ship was full start creating real instability. And if you unload in the wrong sequence, or if a storm hits in the first year, the whole thing can destabilize in ways that never would have happened when the ship was full and heavy and low in the water. Your savings are the cargo. The market is the ocean. Retirement is the moment you discover you've been operating a loading vessel with a completely different set of unloading physics that nobody handed you the manual for. I'm going to call it the loading vessel problem, and we're going to keep coming back to it. In about 12 minutes, I'm going to show you what happens when a retiree's effective tax rate in their mid-70s ends up higher than it was during their working years, which sounds like a bad joke until you see the IRS mechanics behind it. But first, there is a specific risk that destroys more retirement plans than bad investments, bad advice, and bad luck combined. And it has almost nothing to do with what the market does over the long run. Here's what most people get wrong about market risk in retirement. They think the danger is a prolonged bear market, a decade of negative returns. And yes, that is obviously bad, but the actual killer is far more specific, and it can occur in a market that performs perfectly fine over a 30-year window. It is called sequence of returns risk. And I want to tell you about 2 brothers. Call them Martin and Frank. Same upbringing, same industry, similar salaries for 40 years. By early retirement, each had $800,000 in a diversified portfolio. Same allocation, same withdrawal plan. 4% a year, $32,000. Let the rest compound. Textbook planning. Martin retired in January of 1998. The market was on a historic run. His first 2 years, the portfolio grew faster than he was withdrawing. By January 2000, even after 2 full years of living expenses coming out, his portfolio had climbed to roughly $900,000. When the dot-com crash hit, it hurt, but he was pulling cargo from a heavy, stable ship. He had ballast. Frank retired in January 2000. Same 800,000. Same plan. His ship hit a storm immediately. The S&P 500 dropped 49% peak to trough over the next 2 years. The NASDAQ fell 78%. By January 2002, Frank's portfolio wasn't 800,000 anymore. It was down to approximately $430,000. And that's after accounting for his withdrawals on the way down, compressing against falling prices. The market eventually recovered. But Frank was now withdrawing $32,000 a year from a base of $430,000. That is not 4% anymore. That is 7.5%. The compounding math runs in reverse. He never gets back to full load. He runs out of money before 80. Martin is still fine in 2026. Same savings, same market. Over the full period, both brothers experienced identical long-run average returns. Same withdrawal rate. The only difference is which years the returns arrived, relative to when the unloading began. Frank's storm hit while the cargo was still high, the ship still light and vulnerable. Every share he sold during the crash was a share that never participated in the recovery. Here is the number that makes this concrete. A 40% portfolio loss in year one of retirement is far more destructive than a 40% loss in year 20. In year 20, you've already withdrawn a large portion of the original capital. Less is at risk. In year one, everything is exposed simultaneously. You are liquidating cargo in rough water just to cover your grocery bill. The 4% rule, the withdrawal rate that almost every retirement calculator defaults to, was derived from a 1994 study by a financial planner named William Bengen. He was analyzing 30-year retirement windows using historical S&P return data. 30 years. If you retire at 62 and live to 94, which the Social Security Administration's actuarial tables treat as a realistic planning horizon, you are looking at a 32-year window that has already expanded past Bengen's original model. The historical failure rate of the 4% rule at 40-year windows is roughly double what it is at 30. This is a loading vessel designed for a single Pacific crossing, being used for a full circumnavigation. The standard financial advice still leads with 4%, as though the 1994 paper was the final word on the subject. The industry printed it in the brochure. 3 decades later, nobody updated the brochure. There are 3 structural moves that address sequence of returns risk specifically, and none of them require you to predict the market. First, build a cash buffer before you retire 2 to 3 years of total living expenses, held completely separately in something that doesn't move with equities. High-yield savings account, short-term treasury ladder, the vehicle, is less important than the separation. The job of this cash is not to grow. Its job is to be the cargo you unload during storms, so you never have to sell equity at a discount. Frank had no buffer. When the market dropped and he needed income, he sold shares at 40 cents on the dollar. The buffer converts a sequence of returns event from a permanent impairment into a temporary inconvenience. Second, build explicit withdrawal flexibility into your plan from day one. Even a 10 to 15% reduction in withdrawals during a down market year, pulling 28,000 instead of 32,000 for 1 year, makes a statistically meaningful difference in portfolio longevity when backtested across historical return sequences. Not dramatic austerity, small adjustments at the right moment. Cargo stays in the hold a little longer during the storm. Third, sequence your withdrawal sources in a specific order. Taxable accounts first, traditional 401k or IRA accounts second, Roth accounts last. This sequencing has major tax implications, and that is exactly where the second problem lives. There is a tax surprise waiting for people who built their savings the conventional way, and it tends to arrive in the decade they thought they had it figured out. I want to tell you about a farmer and his grain silo. He spends 40 years filling it. Every harvest, grain goes in tax deferred because he is storing it, not selling it. His plan in retirement is to eat from the silo on his own schedule. What nobody told him during the decades he was filling it is that federal law requires him to open the silo doors at a specific age and remove a government-mandated amount of grain each year. publicly in front of the tax collector, whether he is hungry or not. That is the traditional 401k. That is the traditional IRA. And the mandatory removal is the required minimum distribution. The Secure 2.0 Act, passed in 2022, pushed the RMD starting age to 73. Here is what that means in practice. You retire at 62. For 11 years, you manage your withdrawals carefully, maybe stay in a low tax bracket, maybe even convert some traditional IRA money to Roth at favorable rates. Life is calm. The ship is moving smoothly. Then you turn 73, and the IRS hands you a calculation. If your 401k grew to $1.2 million over the decades, which is exactly what you were told it should do, your first RMD is roughly $45,000, fully taxable as ordinary income. This stacks directly on top of your Social Security income. And here is where the trap closes. The IRS uses what it calls provisional income to determine how much of your Social Security benefit is taxable. Once provisional income exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security benefit becomes taxable ordinary income. Your RMD alone can push you past that threshold. Suddenly, your total effective marginal rate, combining your income bracket with the implicit surtax created by newly exposed Social Security income, can exceed 35% in your mid-70s, higher than anything you paid during your peak earning years. Financial planners call this the tax torpedo. I call it the loading vessel problem in its purest form. You built the 401k under accumulation rules. The withdrawal phase has completely different rules. The silo opens on the IRS's schedule, not yours. The financial advisor's standard response to the RMD problem is, we will revisit that as you approach 73, which is very helpful. The IRS was also very understanding about that. By the way, hit subscribe if you like the content. Otherwise, the YouTube algorithm may decide I don't exist. And I say that with the weary acceptance of someone who has read how the recommendation engine actually works. The solution the arithmetic points to, and this is not advice, it is math is Roth conversions during the window between retirement and the RMD trigger age. If you retire at 62 and your taxable income drops, you may be in the 12 or 22% bracket for the first time in decades. That is an opportunity to convert chunks of your traditional IRA or 401k to Roth, paying tax now at today's relatively low rate and permanently removing that money from the future RMD calculation. You are paying taxes on purpose, voluntarily, at a discount, to avoid a larger involuntary bill at 73. The farmer can move grain from the regulated silo to a private pantry, legally, on his own timeline, at favorable prices before the doors are forced open. The window between 62 and 72 is sometimes called the golden conversion window. Most people let it close unused. If your advisor charges 1% of assets under management annually, which is standard, and your portfolio is $800,000, you are paying $8,000 a year. Over 20 years of retirement, factoring the compounding that fee consumes, the total cost approaches $220,000 in foregone growth. An advisor with that fee structure has a meaningful financial incentive for your assets to remain in managed accounts. The Roth conversion conversation, which involves moving money out of those accounts, is not always the first thing they raise unprompted. I am not saying they are dishonest. I am saying incentives are incentives, and incentives shape conversations more reliably than ethics does. Knowing these numbers and building a system around them are genuinely different things. I spent a significant amount of time going through 50 years of actual retirement data, EBRI studies, Social Security Administration, actuarial tables, IRS publications on provisional income calculations, sequenced withdrawal research, trying to understand what actually separates retirement plans that survive from the ones that quietly fail. And I turned that research into a digital book called The Exit Code. Two things from it are directly relevant to what we've been discussing. There's a chapter on what I call the $14,000 invisible bill, the annual insurance cost that most retirement projections undercount for people who exit work before 65. It accounts for actual out-of-pocket exposure in the healthcare gap years. including what happens when your retirement income puts you above the ACA subsidy threshold. Most retirement calculators acknowledge healthcare costs in a vague, single-line way. The actual number for most early retirees is not vague, and the chapter shows the math for multiple income scenarios. The second element is the dynamic withdrawal method, the mathematical framework that replaces the static 4% rule for people with retirement windows longer than 30 years. It is built on back-tested withdrawal sequences across every major market cycle from 1973 through 2023, 5 decades of data. It shows specifically how much flexibility in your withdrawal rate is required to survive a sequence of returns event in the first 5 years of retirement, and what that buffer looks like in actual dollar terms for portfolios ranging from $400,000 to $2 million. This is the unloading manual the financial planning industry never hands you. The exit code is available through the link in the description. It costs less than dinner out and takes about the same time as a slow Sunday morning to read. Every year, the unloading phase runs without this framework, costs compounding in the wrong direction. That is not marketing language. That is arithmetic. Now, the healthcare gap deserves its full treatment because it is the piece of retirement planning that gets the least realistic modeling in standard projections. According to Kaiser Family Foundation data from 2024, the average employer contribution to an employee's health insurance premium is approximately $14,600 per year. That is money your employer sends directly to the insurance company on your behalf every single year that never appears on your pay stub and that you have almost certainly never consciously factored into your compensation calculation. The day you retire before 65, you assume that cost in full. If your retirement income puts you above 400% of the federal poverty level, which in 2025 is approximately $62,000 for a single individual, you do not qualify for ACA, marketplace subsidies. A 62-year-old purchasing a silver plan in most states is looking at premiums of $900 to $1,400 per month individually. For a couple, the range runs from $1,800 to $2,800 monthly, depending on state and plan type. That is between $21,600 and $33,600 per year in premiums alone, before a single copay, before a single deductible dollar, for 3 years, until Medicare eligibility at 65. Here is a specific scenario. A couple, call them Sarah and James, both 59, planning retirement at 62. Combined projected retirement income, $72,000 per year from portfolio withdrawals. They are above the ACA subsidy cliff. Their benchmark silver plan premium in their state runs approximately $2,200 monthly. For both of them, that is $26,400 per year in premiums. Their retirement plan modeled healthcare costs at $15,000 annually. The actual bill is 76% higher than the model. And that is before James needs a procedure in year 2 that triggers their deductible and out-of-pocket maximum, another $9,200 they were not holding reserves for. The insurance company representative, completely sincere, told Sarah, "Congratulations on your successful retirement," and then quoted the monthly premium. On the same call, here is the reversal you need to sit with. Most people assume the healthcare gap is a problem for people who retired without enough money. The reality is the opposite. If your retirement income is low, ACA subsidies cover most of your premium. Some people in their early 60s pay under $200 per month for solid coverage. If your retirement income is solid from dividends, from portfolio withdrawals, from any pension, you are above the subsidy threshold and fully exposed to market rate premiums. The more successfully you saved, the harder this specific problem hits. That is the loading vessel problem at its most structurally absurd. The move that changes this is income architecture in the early retirement years. If you structure your 62 to 64 income to stay below the ACA subsidy cliff by drawing from a Roth account or a taxable account with mostly return of basis rather than from a traditional IRA, you can qualify for subsidies that reduce your premium by $8,000 to $12,000 per year legally. The rule is explicit about this. The number of people who know to ask for it is far smaller than the number who could benefit from it. Your accountant should be running this comparison for you before you retire. If they haven't raised it, ask for it by name. Let me bring in someone I've been tracking through this video. His name is Dave. Dave is 59. He did everything correctly. Maxed his 401k every year for 26 years. Paid off the house, no consumer debt. $1.4 million in retirement accounts. $80,000 in a taxable brokerage. His financial advisor ran a Monte Carlo simulation showing a 92% probability of not running out of money. Dave retires at 62, feeling reasonably like he won. Month 1, healthcare.gov. His projected retirement income is $58,000, carefully structured. It still puts him above the subsidy threshold. His silver plan premium, $1,140 a month. He writes the check. It wasn't the number he expected, but he handles it. Month 7, market drops 11% in a rough quarter. His regular withdrawal is due. The bills do not care about market conditions. He sells shares at a discount, not catastrophic. But the arithmetic has shifted. He is now withdrawing from a slightly smaller base. The ship is riding a little higher. Now here is the part of retirement planning literature that mentions the following reality and then moves past it quickly, as if acknowledging it fully might be inconvenient. The psychological mechanics of leaving work are not soft variables. They are hard ones with real financial consequences. A study published in the Journal of Economic Psychology found that the single largest predictor of retirement satisfaction controlling for health, income, and financial security is whether the retiree has a structured, literal answer to this question: what am I doing next Tuesday? Not a philosophy about purpose, a schedule, a reason to be somewhere specific at a specific time with specific people expecting something from you. Most people plan the cargo for 30 years. Nobody plans what happens when the loading cranes go quiet. Rand Corporation survey data from the American Working Conditions Survey found that a significant share of people who self-identify as retired, particularly those who left work before 65, return to paid employment within 2 years. The most common reason cited is not financial pressure. It is loss of structure, loss of professional identity, and the absence of what psychologists call role clarity, the sense of who you are, that for most people in their 50s was previously answered entirely by what they did. Here is where the soft problem becomes a hard one. When people return to work unexpectedly after retirement, they negotiate from a weakened position. They've been out of the field. Their professional network has cooled. Their specific skills carry diminishing market value with each passing year. They typically return at 60 to 70% of their pre-retirement compensation. That would be manageable on its own, except many of them claim Social Security early because they thought they were done. And Social Security is irreversible. For someone born in 1960 or later, full retirement age is 67. Claiming at 62 reduces your benefit by 30% permanently. Waiting until 70 increases it to 124% of the full retirement age amount. If your full retirement age benefit is $2,000 per month, claiming at 62 gives you $1,400. Claiming at 70 gives you $2,480. That is over $12,000 per year of difference, inflation adjusted, federally guaranteed for the rest of your life. Over a 20-year retirement, the cumulative gap between a 62 claim and a 70 claim exceeds $180,000 before accounting for investment opportunity cost. The break-even age, where the cumulative benefits from waiting until 70 surpass what you collected by claiming at 62, typically falls between 79 and 82. An American male reaching 65 today has an average life expectancy of 83. An American woman reaching 65 today lives on average past 86. These are averages, which means roughly half of all 65-year-olds today will live past those ages. The math of waiting favors most people in reasonable health. Most people claim early anyway. Because the psychological pressure of leaving monthly income uncollected, the visible, concrete, this dollar could be in my account right now pressure, beats the abstract future math argument almost every time. The brain values certainty in the present over probability in the future. This is not a character flaw. It is how human decision-making works under uncertainty. It is also the mechanism that costs retirees, in aggregate, billions of dollars annually in permanently foregone Social Security income. ProPublica and the Urban Institute ran a joint analysis of health and retirement study data that produced a finding everyone in their 40s and 50s should read at least once. More than half of full-time workers over the age of 50 are involuntarily pushed out of long-term employment before they plan to retire. Layoff, health decline, corporate restructuring, caregiving obligations, the forced exit arise before the financial exit was planned. And because most people have built no architecture for an unplanned early departure, no cash buffer, no Roth conversion runway, no Social Security bridge strategy they claim early, permanently lock in a reduced benefit and absorb sequence of returns damage simultaneously from a ship that was not yet fully loaded. The retirement plan assumed you chose the exit ramp. The data says you probably didn't. Here is what none of the brochures say. The entire retirement architecture, the 401k contribution limits, the Social Security benefit structure, Medicare's 65 age floor, the ACA subsidy design, every piece of it was built around one assumption, that you work until 65, transition on schedule, and begin drawing benefits in an orderly sequence. This system was not designed to support early retirement. It was not designed to support involuntary retirement at 58. It was designed by and for institutions whose financial health depends on you remaining employed, contributing, and drawing on services at precisely the scheduled intervals. The moment you deviate from that timeline in either direction, the machinery penalizes you. The loading vessel was built by people who profit from you loading it. The unloading manual was never part of the original package. Let me bring Dave back one more time, because his story has an ending worth noting. 18 months into retirement, Dave is fine on paper. The portfolio hasn't collapsed. The insurance premium is irritating, but not catastrophic. But Dave is calling his financial advisor more frequently than before, and not about the money. He describes feeling like something is missing. His advisor recommends hobbies. Dave tries hobbies. The hobbies don't close the loop. 14 months after that, Dave takes a part-time consulting role, 20 hours a week, roughly $42,000 per year. He does not need it financially. He needs it structurally. He needs the loading cranes to make some noise. What Dave does not realize, and what I find genuinely interesting, is that by generating $42,000 in earned income during years 2 through 5 of retirement, he has accidentally neutralized his sequence of returns exposure. During market downturns, he draws from the consulting income instead of the portfolio. His cargo stays in the hold during storms. The Monte Carlo simulation his advisor ran assumed 0 earned income. The actual Dave is materially safer than the simulated Dave entirely by accident. The financial takeaway is not go back to work. The financial takeaway is this: supplemental income in the first 5 years of retirement is one of the highest leverage risk reduction moves available to a retiree. Even $20,000 per year from part-time consulting, rental income, or freelance work cuts the withdrawal rate during the most sequence-sensitive window. The ship needs less unloading during the roughest water. The cargo holds. The statistics change dramatically. 3 practical moves. Specific ones calibrated to this topic only. 1. Build your 2-year cash buffer before you retire. Not during retirement, not after before. Calculate your actual annual expenses, including the real healthcare premium you will pay if you are under 65, and multiply by 2. Put that exact amount in a high-yield savings account or a short-term treasury ladder, completely separate from your portfolio. This is your storm fund, not your retirement savings. When markets fall in year 1 or year 2, you live from this account and leave equities alone. The compounding on your portfolio continues uninterrupted while you are weathering the drop. Begin building this fund 3 to 5 years before your target exit date, so you are not rushing to accumulate it and disrupting your investment strategy in the process. 2. Model your healthcare income architecture as its own planning project before you retire. Go to healthcare.gov and get a real premium quote using your actual projected retirement income. Then model the alternative. What does your income look like if you draw from a Roth account or from a taxable brokerage with mostly return of basis in years 62 through 64. Bring this specific comparison to your accountant, not your financial advisor, your accountant, and ask them to run the numbers side by side. In scenarios where restructuring saves $12,000 annually in premiums, the math pays for significant planning effort. If your accountant has not raised this conversation, they may not specialize deeply enough in retirement phase planning to do it automatically. 3. Treat your Social Security claiming age as the most consequential longevity bet in your financial portfolio, not as a cash flow management decision. If a cash shortfall would force you to claim early, solve the cash shortfall first, through the buffer, through supplemental income, through a one-year spending adjustment. Then make the Social Security decision with longevity math at the center, not short-term income pressure at the center. The longevity math does not care how urgent the short-term pressure feels. The benefit reduction is permanent regardless. The month you stop working, the loading cranes go quiet. The ship rises, the center of gravity shifts, and the operating manual you followed for 30 years, the one about maximizing contributions, compounding returns, staying invested for the long haul, quietly stops applying. Different ship, different physics, different rules. Lazy investing built more fortune than crypto memes. The retirement industry knows the unloading manual exists. They just profit more from selling loading equipment.